Okay, good. And where we had left off on chapter 6, and again, it wasn't ideal. We did stop, unfortunately, in the middle of a module. Okay. I did have all these open. Yeah, okay, there it is. Okay. And we did stop in the middle of the module. We stopped in the middle of the module talking about leases. We had completed the discussion about the leasee accounting. And so now we're going to turn our attention towards lessor accounting, seeing how the entity that owns the asset that is now leasing it to another party will account for that. And then we're going to, and we still have some little bit of work back looking at leaseback sale, leaseback. And then from this chapter 6, I want to get us into the foreign currency discussion. As I mentioned last time, there's still some discussion about derivatives and deferred taxes that I am asking you to have looked at on your own. The derivatives is fairly light on the exam, but you definitely want to spend some time with that deferred tax discussion there, because there will be 10 points associated with that. I think we will finish what I want to cover in chapter 6 tonight and be able to start to turn our attention to chapter 7, hopefully finishing up that discussion, if not tonight. Next time, that'll allow us then to progress into chapter 8 after that. Okay, so that's the game plan anyway, going forward. Let me put machine and tablet mode. Yeah, I had a feeling. I don't know what it was. Something made me feel it was going to do that. So let's see if we get lucky and can turn the camera back on without crashing everything. Okay, let me try this one more time.
It looks like your computer needs more RAM.
Okay, it looks like I'm back, and yeah, I heard some comment made about the computer. Don't get me started on the hate that I have for this machine. I've hated it from the day I got it, and I still hate it because it's never cooperated. It wasn't the machine I wanted when I went, but that was all they had. And I was in desperate need of something to run class that night. That's what I've been stuck with ever since. So one of these days I will smash it with a hammer and I won't have to worry about all that anymore. In the meantime, okay, let's go ahead and roll with what we've got here, which is our pickup of the discussion, lessor accounting. Okay, we're still recording. Okay, good. So when we look at the lessor accounting, okay, what we are really going to see here there are basically two types of leases that we're going to contemplate. One is going to be a sales type lease. The other is going to be a financing lease. Now, when we have a sales type lease, okay, there will be a gain on the sale. Okay, so when you have a sales type lease, often the question will be asking you, well, what's the gain on the sale? They may be asking you some of these other journal entries, but we'll get into that as we move along. But there will always be a gain on the sale when it's a sale type lease. If it is a direct financing lease, which is our other option, there'll be no gain on the sale. And so you'd say, well, why is the lessor doing this? The lessor is doing this because they're trying to generate interest income. And so there'll only be interest income on that. Okay. So when we take a look at this, they say that in a sales type lease, the lessee gains control of the underlying asset. So the lessor will de-recognize the asset. In other words, we're going to take the asset off of the books, and then we will go ahead and recognize a net investment in the lease, as well as a profit or a loss. Again, there's almost always a gain on the sale. Again, it's unlikely that the lessor would do this unless they thought they were going to have some sort of gain on the sale. So go ahead and flashcard that basic idea. I'm not going to worry about that journal entry there because later on they give us a numeric example, and I'm of the opinion that it's easier to understand a journal entry when they give you some numbers on that. Okay, now one sort of nuance we'll see here that we want to understand for initial direct costs. You have to pay commissions or something like that, legal fees on the lease. If there is a profit or loss, then we'll expense the direct costs at the commencement date, the date the deal is given. This is the matching concept. Since we're taking a gain, we'll take that gain immediately at the initiation, at the commencement of the lease. If there is no profit or loss, and then again, we'll probably just recognize interest revenue, then any direct costs need to be amortized over the term of the lease. Okay, so flashcard that, and we're going to go ahead and take a look at both considerations here as to whether there is or is not profit or loss with a set of facts. Okay, so let's just look at this example here, and you'll kind of see some of these finer points that we just called out here in this example, and you'll see that journal entry. And so we have this Jenkins Inc. leases a truck to Briggs Company for 4 years at $5,000 per year with initial direct costs of $450 and a interest rate of 6%. On the date the lease commences, the carrying value of the asset is $22,000. Fair value is $24,216. So we know there's going to be a profit because they're selling it for more than its book value, right? Okay, so Jenkins expects that the truck will be worth $8,700 at the end of the lease. Now they tell us to go ahead and generate this journal entry. If the lease is treated as a sales type lease, assume the collection of all amounts is possible, reasonably probable. Determine the journal entry on January 1st. And first, we have a gross residual asset, which is the present value of that $8,700. Now think about that. We're going to get this equipment back at the end of the lease. So that's something that we have coming to us, as well as what? As well as the present value of those payments of 5,000 at 6%, and they give us the present value on that. So notice we go ahead and we recognize the asset, that residual, the present value of what we think we're going to get back at the end, the value of that 8,700 present value. Lease receivable, the present value of those 5,000 a month at, 5,000 a year at 6%. We get the present value on that. Okay. The amount that is being paid as these residual fees, and since there is a profit on this, a gain on this, we will expense that immediately. So that we're recognizing that at the same time that we're taking the gain, and you can see the gain here is this 2,261, which is the difference between the sum of the residual asset and lease receivable less the carrying value of the truck. And that makes sense. We have these payments that are coming back. We're going to get this truck, but the truck has a carrying value of what? Of 22,000. So that's essentially what our profit is everything that we're going to get back from this, which is the cash that we're going to receive in the future, plus what? Plus the truck that we're going to get back at the end. That's sort of what we're receiving, even though we're leasing the truck, we're giving it up, but we're going to get it back. So that's part of our compensation versus the book value of the truck. That difference is that gain. And then we have to take the truck off the books at this point until we receive it back. Obviously, right now, it's just in the form of a residual asset that we'll be getting back later when they hand that hunk of junk back to me, right? And then, of course, we have to credit the cash now for the 450. Okay, so go ahead and you can flashcard that journal entry. I think it is helpful to have that journal entry flashcarded, just so that you kind of could, if you were asked a full journal entry on the CPA exam, you could go ahead and sort of put the journal entry together saying, well, I know I have to take the expense because there's a gain. The difference between what I'm going to receive and what the book value is a gain. The book value of the truck has to come off. And depending on what they're asking you, sometimes they'll give you a question where they ask you a piece of the journal entry. Remember, I tell you for CPA exam, don't fall into that trap. Make the full journal entry and then select whatever the choices are. That's the correct choice, obviously, that they're asking you would be part of that journal entry. Okay. Now, if it is a direct financing lease, well, now there's no gain on the sale. Okay, when it's a direct financing lease. So you say, well, if there's no gain on sale, why is the lessor doing this? And the reason is they simply want to do what? They simply want to make the interest income. Okay, so now they say what? Any gain, which is essentially interest income. So they're calling it a gain. I'm going to call it interest income because that's what it is. Okay, the book probably should have called that a gain because it's interest income, will be deferred and amortized over the loss of the asset. Any loss would be recognized immediately if you have that. But just flashcard that what you're going to amortize and what you're going to recognize is interest income. So at the time that you go ahead and let's just look at what we would do here in this example now for a direct financing lease, where again, we're only trying to make interest income. There is not going to be any gain on the sale. So Jenkins lease a truck for 4 years, $5,000 per year with initial direct cost of $450. Implicit rate is 6%, which is the same facts as we saw before. The date the lease commences, the carrying value of the asset, and the fair value of the truck are $23,767. So essentially, they're selling it for their carrying value. They're not trying to make a gain on the sale. They're just trying to generate interest income, and then they expect it'll be worth $8,700 at the end. So what happens if the lease is treated as a direct financing lease? We will take this net truck investment in the lease, net investment, I should say, in lease of $24,217. That's what? That's the $23,767 plus the $450, because now we're not going to expense that because we're going to amortize that over the term that we're recognizing that interest income. so that we have a nice matching between the income that we were wanting to generate on this, which was interest income, and the expense that we had to incur to get into this deal to begin with. Okay. Now, when we take a look at that, and of course, we're going to credit the truck for its book value, and then we'll debit the net lease investment for whatever the carrying value of the truck is, again, plus that initial direct cost. Now, when you come over and we start to recognize some income on this thing, notice that we will have to disclose what the receivables were and whatnot in the residual asset of 6891. So all those are disclosures. And then the net investment, you can flashcard those disclosures. I don't know why they buried a disclosure requirement kind of down there, but flashcard what those disclosure requirements are, and then take a look at what the net investment in the lease in this example is equal to the 17,361 plus that 861, and then we have those initial direct cost in there, and then we go ahead and we bring in the cash at 5,000. We credit, this is after the first payment, we credit interest income, and we credit the net investment in the lease, and the interest income is calculated by taking that 6% times the initial carrying value of that, which was that 24,217. You would go ahead and multiply that, and that's where you get the 1435 is the interest income, and then the difference between that and the payments is going to reduce the liability, the liability of the person leasing the equipment. To us, it's going to be an asset that we will then go ahead and reduce the carrying value of that asset, and that interest income will be that much less the next time through. Okay. Okay, good. Now, you come over and you take a look at the consideration if it is a, let me make sure I gave you that calculation correctly. I think I included, I said it's time to 24,217, and that's not correct. It's actually 24,666 times 0.06. What do you get on that? 24,666. Does that give you that number that they gave you there for the interest income? Gives you the
1,079.
okay, okay, good. So then I guess I was looking at something else. I don't know where I got 24,006. Oh, I see. I can't read my own writing. 24,664. Does that make a difference? I know I had checked that calculation. 24,000.
It's actually the 24,217 times 0.06.
24,217, you're saying? Yeah. Okay.
Yes.
Which is what I said originally. I don't know why
Yes.
I wrote something else stupid in my book. I guess I can't. I wrote something in there. I don't know where I came up with that other number. 24,217 times 0.06, Roy. Gives us that, which is what I
Yes.
said initially.
Yes, that's the interest. Yeah.
For some reason, I'm going to fix that now, so I don't make that mistake in the future. I wrote some other number down there times 0.06, and that's not correct. It's 24,000. John, 24,216. Okay. Okay. Yeah. And The part that's bothering me is they're giving us that 24,217. But they're not, okay. What the hell are they doing to us? Let me look at this. 17,326, right? Plus 6,891 is 24,217. Truck. $23,767. Where are they coming with that 23,667? That's a little confusing. This 23,767. Did they ever tell us? Yeah, they told us that right there. That 23,767. But then they go ahead and say that the 17,000 and the 6,891 equals a 24. Okay, well,
Is
anyway.
it because we are not recognizing any gain, and so we like kind of convert the book value of the truck into the investment plus the cash direct cost of the transaction, and that's what we're financing.
Yeah, I'm just trying to figure out where'd that 17,363 come from then. 17,325. 17,000. I don't know, that's a little confusing. I'm gonna have to look at that. I'll have to get back to you guys because I'm not quite understanding how the present value of this 17,325 and the present value of this 6,891 come up to that same number, 17,325. And they're expensing that. Something isn't adding up for me here, but bottom line, guys, the main thing is to take is that net lease investment here would be to take that 450 and include it in the net lease asset, and then that's how it's being amortized instead of expensed up front. I'm just not understanding how this number is coming out to be that 23,767. I'm not getting that. Oh, 23,767. Yeah, I see they're reducing the 24,217 by that number. I don't know. That's confusing. Bottom line, though, what I want you to remember here, the key thing is with that 450 anyway, is that you amortize that as you amortize that whole receivable, you include that in the receivable and you amortize it, whereas in the sales type lease, we took it as an expense, okay? If it is an operating lease, okay, then it's pretty easy. You can flashcard these journal entries. You simply do what? You simply go ahead and whatever cash for an operating lease now, you simply debit any cash, okay? So if it hasn't met the requirements for a capital lease, neither a sales type nor direct financing lease, then you're going to debit the cash and credit the rental income for whatever you're charging them per year, or month, or whatever it is. And because you are not assuming that they're purchasing that asset from you, you go ahead and you report that depreciation expense. Okay, now, so flashcard that. Now, couple of balance sheet issues, okay, that we really have already understood, but let's just go ahead and remind ourselves that we have that right of use asset that's being amortized, okay, and then we're going to amortize that using straight line, okay, and notice, and this is for a finance lease now, not an operating lease, for the finance lease, because we have to depreciate that asset. We said that last time. And notice here, and something that's easy points on the exam that you should flashcard here, if we are using the ownership transfer or the written purchase option that we're likely to exercise, probably because it's a bargain for us, then if that's the case, then we will amortize over the life of the asset, because the idea is we're going to end up owning that asset because there's an ownership transfer below, or we're going to exercise that option. We'll own that asset. If we have qualified for the lease, remember we looked at that criteria last time, because the net present value of the lease payments are substantially all of the assets about fair value, or we're leasing it for substantially all of the life of that asset, or it is a specialized asset, well, then it's contemplated that you're probably going to turn that back to the lessor at the end of the lease. And so you would amortize that over the shorter of the lease term or the useful life. And generally, the lease term would be the shorter there. You'd be kind of crazy if you're still paying on a lease in which the lease term is longer than the asset life. That would probably not be the best business decision. Okay, so flashcard that. Okay, and then as we saw last time, for the income statement, our lease expense will be included in income from continuing operations on the lessee's income statement. You can go ahead and flashcard that if you want, but obviously, lease expense is on the income statement and it's an operating expense. It's not a non-operating item. Okay, come over and look at the statement of cash flows. Okay, and you can flashcard this table. I think it's useful. Okay, notice almost everything goes into the cash flow from operating activities. The couple of things that don't is preparing the asset for its intended use, and the principal payments, preparing the asset for its intended use, the cash flow for investing. Principal payments are cash flow from financing. We're going to talk about statement cash flows. Maybe we'll get to that tonight. And then you notice some of these other things, everything else is cash flow from operating expenses, including, you can see, variable and short-term lease payments not included in the lease liability. I mean, almost all of these are pretty straightforward. I'm highlighting that one because we're going to have a question on it, and that's not something that leaps to mind, but it's pretty straightforward that almost everything is going to be cash flow from operating activity. Okay, good. Now we can go back and, flashcard the disclosures, guys. I'm not going to get into, reading off disclosure requirements to you, but make sure you're flashcarding, or at least looking to your flashcards to see what the lessee and the lessor is expected to disclose in case you get asked a question that asks something like that. You've got a shot at getting something like that right. These disclosure questions get a little annoying, but go ahead and make sure you have a flashcard on that. Okay, good. Let's go ahead then and let's take a look at our first question for tonight. Are you seeing the poll? Because I'm not.
Yes,
Nope.
I see it.
You see it? Okay. I don't know why it's not putting it up on the screen. That's okay. Okay, guys, let's go ahead and take a look at this one. Everyone's rushing in here with their choice now, but okay, good. And just about everybody got this right. Let's go ahead and take a look at this one. And I can kind of see why maybe somebody got D. Maybe if you were still kind of struggling with what period they were asking you for, but just about everyone got this right. The answer here is C. Okay, and so let's go ahead and let's just take a look at this one. And we have this beginning of the year. Kennedy enters into a 4-year operating lease with payments due at the end of the year, beginning December 31st, year 2. The rate implicit in the release is 4.5%, and Kennedy will owe annual payments of $5,200. And then they give me the present value factor for that annuity at the 4.5% interest rate. So I'm going to pick up what? I'm going to pick up that 5,200. I mean, I know I need to have that number in the calculation somehow because all my choices have dollar amounts, and that's the only piece of information that probably had a dollar amount associated with it. And I multiply that times the 3.5875. That means if the present value of those payments is 18,000, okay, 655. Okay, but since this is what? Since this is an operating lease, okay, I'm going to have to go ahead and amortize the right of use asset, and I'm not going to amortize it using the life of the asset because it's an operating lease. I'm going to amortize it as I also amortize the liability on the lease, and those amounts amortize at the same rate. So I'd have to pick up that 18,655, okay, and I'd multiply that by the 4.5%, okay, and when I do, I get first year interest expense of $839.47 or something stupid like that. Okay. Now, if I go ahead now and I say, well, that first lease payment, they tell me is $5,200. But what some of that was going to be the amortization on the lease liability and the right of use asset, which is what they're asking me here, what the carrying value of that right of use asset will be at the end of the first year. That means that what? Only $4,360, and what would that be? 52, 53 cents, something stupid like that. Okay, is going to go towards the principal. So if I started out at what? 18,655, and then I had to amortize some of that right of use asset for an operating lease, not using the years of the life, but like I would amortize the liability at the same time. I would amortize that asset over that same rate. That would give me what? 14,294 and some, odd, stupid number of cents or something. And so that gets me close enough to what? 14,295, which almost everybody got. Okay. Okay, good. Let's go ahead and take a look at question 2 then. Okay, guys, I'm gonna go ahead and end the poll on this one. It's been the full 2 minutes. And, you know, I look at this question, I start to think to myself, this looks like something Becker probably invented, and they had to get a little bit cute by saying that something would positively or negatively impact. In other words, would we subtract it or add it to our cash provided by operations? And obviously, if we're sitting here, most of us got this right. The answer is B. Obviously, if we're sitting here and what we're talking about situation where we are making what past payments, okay, then that's going to what negatively affect the cash flow. So we're making payments on this, and there's not going to be a positive impact. So then you're down to, well, which of these negatives should I take? And we know that the principal amount, which was the only one that was in way over in that financing section, would be there. And then per the flashcard that I asked you to make, we're left with the negatively impact, but variable lease payments not included in the lease liability, which was a little more esoteric, but we have a flashcard on that. And I have a feeling that the exam probably wouldn't get into that level of granular discussion of effect on statement of cash flows for something like that with the lease. So I have a feeling Becker wrote this question. I don't know that you'd see something that granular on your exam. Okay, good. So let's go ahead then and come back. And I want to come back, and I should have stayed in full screen mode. And let's take a look at sale leaseback. Okay, and we kind of had skipped that last time because to me it flows more that we've talked about the lessor, we talked about the leasee, but now what's happening? Now we're going to go ahead and we're going to sell an asset, and then we're going to simultaneously lease it back from the person that we just sold it to. Now, the best example that maybe you've dealt with, or you haven't dealt with this specifically in business, is you sell your house and then you're not ready to move yet, so you simultaneously lease your house back from the person you sold it to. Okay, it's that kind of a thing. And what we're going to see is, does it really meet the definition of a sale? If it does, then we're going to recognize a gain and whatnot, because we would have actually sold that asset and we're simply leasing it back maybe for a short period of time or something. If we're not meeting the criteria for a lease, they're going to say, hey, this is not a lease, this is not a sale, at all. It's a lease, it's not a sale. And you're going to not take any gain at the time that you sell that, and the entire thing is going to be a financing arrangement. Okay, so when you look at that, we're going to see, well, what is the criteria that will cause it to be recognized as a sale, or they call it a failed sale, and how that will then justify how we account for it. So a sale leaseback occurs when one party, the seller that has control of the asset, transfers it to another party, the buyer, and then subsequently leases the same asset back, where the seller becomes the leasee and the buyer now becomes the lessor. So now you're essentially leasing back the thing you just sold, of course, if it qualifies for a sale. Okay. Now you can come down and say, well, how do we know if we have actually met the sale? Okay. And let's just take a look. If an asset transfer involves either two key situations below, the transfer may or may not be considered sale depending on the circumstances. Okay, so let's take a look at this and let's flashcard these, because this will help us determine whether or not it's a sale. Okay, to meet the criteria to be a sale, both of these bullets criteria have to be met. The option exercise price already is or will be the same as the underlying asset's fair value at the time of exercise. Now that makes sense in that if it's matching the fair value, hey, you're pretty much buying that, right? Okay. Or the alternative asset that are substantially equivalent to other underlying assets are readily available in the marketplace. If both of these criteria are not met, then it is a failed sale and it'll be treated as a financing transaction. So it's either going to be what? A sale, leaseback, or it's going to be a financing transaction. What's the difference between the two? Sale, leaseback, we're going to take some gain. For the financing, there's not going to be any gain on that. Okay. Now, let's look at any residual guarantee value. Residual guarantee value, you lease a vehicle, they say, hey, we're not going to let you just wrap this thing into junk and think that you're not going to have to give us something back. Okay. So that residual guaranteed value, a sale cannot take place if control of the asset has not been transferred to the buyer. If it is a qualitative judgment, but the more significant the guarantee, the more unlikely that the control has been transferred. If you're going to have to essentially keep them whole on that asset anyway, then you probably don't have a sale. And again, that would be a failed sale. Okay. Now you come over and let's just take a look at the facts. Now, if we meet those criteria for the sale leaseback, how would that look? We know that there's going to be some gain on the sale because the criteria are met, they tell us. Okay. So billing company held equipment on the books with an original purchase price of $500,000, remaining useful life of 10 years, and a carrying value of $415,000. On January 1st, year 3, billing sold the equipment to Crane for $490,000. Equipment at the time of the sale had a fair value of $470,000. So you're looking at it saying, okay, you're pretty much buying that, right? I mean, you're paying what more, but you're paying at least the fair value. So this is going to meet the criteria. Crane agreed to lease the equipment back for 5 years at these annual payments. They give us the interest rate on that. And then you start to take a look. And obviously, they're giving you cash of $490,000. Okay. When we are looking at the liability here, let's just focus on that for a second. Well, we bought $490,000. We paid $490,000, but the thing only had fair value, I should say, of $470,000. That means the way the standards look at that, you're borrowing $20,000 from them, and you're going to be paying that part back. Okay, when you're starting to make these lease payments, so that $20,000 is where that liability came from. Should draw the arrow up there. Okay, that's where that $20,000 came from. Then what? Then they tell us that we paid $500,000 and the equipment had carrying amount of $415,000. Okay, so that, since we're going to take that asset off the books, we need to take that accumulated depreciation off. So there's the $500,000. The $85,000 is obviously the $500,000 minus the $415,000, right? Because that's what would be in the accumulated depreciation. And then the $55,000 gain is the difference between what? Between the $415,000 and the $470,000 at that point. Okay. That was the book value versus what we sold it for, which was the fair value, which is the $470,000. And the $20,000 is seen as a financing. Okay. Okay, good. Now, in the event that we hadn't met the criteria, guys, and it was the criteria were not met for a sale, leaseback, then the entire amount is treated as a financing agreement. They're saying, hey, in effect, you're borrowing that money from the person that you just sold that asset to, that you're leasing back. In fact, you didn't sell it to them because it's not a sale. Okay, criteria were not met. And so you're going to continue to depreciate that asset. Okay, that $41,500 is the remaining book value divided by the remaining 10 years. And you're going to take interest expense and take a financing liability each period as you accrue that interest, as you amortize that interest. So you would debit the interest expense, credit the financing liability, and then as you, of course, pay on that, whatever it was they said per year, this $112,396, some of that would be interest, payment of the financing liability. You would debit the financing liability for the $112,396 $12,396.50. Since you added the interest cost of that, you would obviously debit that. You would credit the cash as you go, as you now make the payments. Okay. As you make the payments, you're going to debit the cash and credit the liability. Okay, let's see, let's go ahead. We did this question last time, but let's go ahead and look at question 2 since we skipped it last time because we were waiting to do the sale leaseback stuff. Okay, guys, I'm going to go ahead and end the poll on this one. A couple folks put their answer in. Okay. And when we take a look at this one, okay, most of us got this right. The choice is B. And they're asking us, well, what is the liability associated with this? And you have a liability, okay, when you're going to do what? When you're going to sell the asset for more than its fair value. The way the standards are looking at is you're essentially doing what? You're essentially borrowing that difference. Okay, so that $208,000 was the sales price on the equipment, and the equipment had what? A fair value of 202. So since there was only a fair value of 202, they're essentially saying, hey, look, you're borrowing 6,000 because you're getting more cash back than the fair value of the asset. Well, the idea is nobody sells you an asset or buys an asset from you for less than its fair value. So any difference there, it's assumed to be a borrowing, and that's where the 6,000 came from. Okay. Okay, good. So let's go ahead then and let's continue on. And let me go back to the outline here. Okay, so I can kind of see where we were. I'm not going to cover module 3, derivatives and hedge accounting, guys. You probably want to watch the video on that, but it is fairly light. We're talking maybe 2-3 points. Okay. What I want to talk about as we wrap up chapter 6 here tonight is the foreign currency. Okay, now the reason I stopped to talk about foreign currency here is that on the exam, they might ask you some questions directly about foreign currency, either transactions or they may ask you about situation dealing with foreign currency translation or remeasurement. If they're asking you questions directly about that stuff, probably fairly light point value question worth of questions, a couple multiple choice questions, okay? Where they're going to get more involved, okay, is if we are talking about either, and they say, and we'll look at transactions, by the way, towards the end on page 46. Okay, where they're going to get more involved is if they're talking about foreign currency translation or remeasurement. Okay, and whether it's translation or remeasurement depends on the fact pattern in the question that they give us. But I had a dream some time ago, okay, that the dream that I had dealt with an exam some time ago, in which the examiners asked you to do a consolidation, which should not surprise you in a task-based simulation. That should not surprise you. They will ask you a bunch of multiple choice questions on consolidation and potentially a full-blown task-based simulation dealing testlet dealing with a task-based simulation and a testlet dealing with consolidation. But in the dream I had, okay, it was a foreign subsidiary, an English subsidiary or something, and you had to first turn the pounds into dollars before you could do the consolidation. So I'm not sure if that was a translation or remeasurement. I'll show you how that works here in a couple of minutes. But the point is that I don't want you dead in the water to not be able to do the consolidation part if you're not able to first remeasure / translate the English subsidiary financial statements into US dollars. Okay, so it is worthwhile flashcarding some of this terminology and then being in good shape to look at the example that I'm going to give you. And so you'll be able to pretty easily work your way, not easily, but you'll be able to survive that question. Okay, so we start to talk about exchange rates. Okay, and let's just understand the different exchange rates here. The current exchange rate is the exchange rate at the current date for immediate delivery. Now, often you will use that, and you'll see it also called the spot rate, okay, but flashcard that. You'll often use that for foreign currency transactions, but you'll also be seeing that if you're doing the translation remeasurement for certain items on the financial reports, you will use the current rate, okay? Historical rate is used sometimes as you're going through that foreign currency translation or remeasurement, and that is the rate that was in effect at the time that stock was issued or an asset was acquired. Okay. Now, sometimes they will either give you, by the way, let me back up. You don't have to go into your head memorizing, exchange rates between US dollars and different denominations. They will give you the exchange rate, but they'll call it out as the current or the historical. Now, where you may need to calculate the rate, and I'm going to show you how to do that here in a little while, is the weighted average rate. Okay, but all I want you to understand right here is this rate is typically used for recurring transactions that occur evenly throughout the period. Okay, and the phrase you're looking for there is the transaction occurred evenly throughout the period. So that's often the case for sales. If that's the case for sales, then that's probably going to be the case for cost of goods sold. If that's the case for cost of goods sold, that's probably going to be the case for inventory, right? Since we're selling our inventory. And guys, I'm going to have to do the whole little battle of the sunshine. Why I find it so annoying that it's freezing cold outside, and then I got to fight the sun when I'm teaching my class. But anyway, you take a look, and it's amounts to have occurred evenly throughout the period. You look for that phrase, then you use the weighted average. You may have to calculate that. They may not give that to you, but I'm going to tell you it's pretty easy to calculate that weighted average here in a little while. Okay, so you can, I'll show you that in a little while. So you can flashcard that. Okay, now when we look, the reporting currency on the exam, guys, it's always the US dollar. Okay, it's always going to be the US dollar. That's going to be the reporting currency. Okay, the functional currency, okay, is where there is the primary economic activity. Okay. Okay, so the functional currency is wherever the primary activity is. Okay, so which the entity operates. So if they're telling you that it's a foreign subsidiary, an English subsidiary doing most of its business in the US, then the functional currency and the reporting currency would be the same. Okay, so you need to look to see where they do most of their business to determine what the functional currency is. Okay, and then we will talk some more about the local currency. Local currency is often where the headquarters of the company is or where they're located, that kind of thing. Okay, so we'll deal with reportive, functional, and local, and we're going to understand what to do once we read the fact pattern and see what's going on with this company. Okay, situation with these companies that, US company that has a foreign subsidiary. Now, foreign currency translation, okay, and we're going to look at how to do that here in a couple seconds. You can put C, page 46, okay, or foreign currency remeasurement. And it's going to be one or the other in most problems, although if you have a third country, you may have to do both. You may have to first remeasure, and then you'll have to translate, and we'll see how that works here when we get to page 46. Okay, all right, now what exchange rates we use depend on whether an asset is a monetary asset or a non-monetary asset, okay, or liability. Okay, so I need you to flashcard this, okay, or if you feel you need to flashcard it, okay, but the way to think of this is what monetary assets stay the same regardless of the change in the price index. Okay, so if you fall asleep with $100 in your pocket and you sleep for 10 years, okay, you wake up 10 years later, you still have what, assuming you didn't fall asleep in a bad neighborhood, you should still wake up with $100 in your pocket. It's not going to change over time. Meanwhile, what, something like, your house, okay, just think of it that way. As the price index goes up, the value of your house goes up, okay? So make sure you know which assets are monetary versus non-monetary, because depending will tell you which of those exchange rates should I use, the historical rate versus the current rate, and so on, okay? Okay, good. Now we come over and we start to take a look at foreign currency financial statement translation, and what some of the rules are here. And I think I said to tell you to see page 46, and I should have told you to see page 37. So forgive me on that, guys. Page 37. That's where I wanted you to go to see, what the book is saying about the definitions on those. Okay, but before I do that, I think it's best if I show you this sort of one-stop shopping flashcard that I have for you, which probably means I'm going to have to see here. Okay, I don't have to log back in, but I do need to get back into e-learning. I had it downloaded at the beginning, but remember I had to reboot, okay? And so let me go ahead and put myself in student mode. So it looks a little bit more like what you're used to. And you come down, and under chapter 6, I have this foreign currency example 1. Okay, so that's where I'm getting that from. I think though I can find it in my files here. Okay. Don't worry that it says financial too. Okay. I have it under chapter 6 for you. Okay, but I think I want to open it with the okay. Time. Okay, good. And I'll go ahead and go to full screen. Then I'm gonna have to zoom it out a little bit though. Okay, I think that's good enough. Okay, so what I did here is kind of just come up with a little example that to me is similar to what the dream was about. Okay, so when you look at this, I have a US company with an English subsidiary doing most of its business in the US. Okay, now what happens? The US currency is the functional currency because they're doing most of their business in the US. And in this case, the functional currency equals what? Equals the reporting currency. Here, so it doesn't spill over to the other. Okay, the reporting currency is the functional currency is also the reporting currency. Reporting currency is what? Always the US dollar on the CPA exam. So reporting currency equals the functional currency. And when that's the case, you use the remeasurement method. Now we'll see that sometimes you'll use the translation method, but we're going to use the remeasurement method. Okay, so we're going to remeasure the English subsidiaries financial statements denominated in pounds, which is the local currency, to the functional currency, the US dollar. And it so happens that that also equals what? That also equals the reporting currency. Okay. So when you are sitting there and you're dealing in a situation where the functional currency is also the reporting currency, or as you're going from local to functional, you have to remeasure. Okay. And so you come over and we have what? We have the balance sheet, we have the income statement. And what this is telling me is whether we have monetary or non-monetary assets, whether we should use what? Whether we should use the year-end rate, okay, which is the current rate, or the historical rate if it's non-monetary. And I say for asset, for inventory, I should say, which is a non-monetary asset, if it's could be weighted average if it the transaction occur evenly throughout the year. For the income statement, you typically will use weighted average unless it's items like depreciation, etc. Okay, that's related to a balance sheet item. Then you should use the historical rate, since you would use the historical rate for, you know, assets like equipment and whatnot that you're depreciating. Again, be careful if they tell you that, you know, the inventory was acquired evenly throughout the year, sales were even throughout the year, then for cost of goods sold, it could be the weighted average. Amortization, it's going to be the historical rate associated with whatever it is you're amortizing. Okay. Now, what they give us here is the what I give you here, okay, is how you would start. So you would first go ahead and remeasure items on the balance sheet, okay, and start with the balance sheet, and then you'll go and you'll plug the retained earnings adjustment to make the balance sheet balance and therefore equal net income. Then you go ahead and you take the net income to the income statement and you plug whatever the remeasurement gain is at that point in time. Now, that gain is part of income from continuing operations. Don't worry about this I in idea. Okay, we're going to actually give you an example of how you would do that here in a couple of minutes. Now, if we have a US company with an English sub doing most of its business in England, now what? Now the English pound is both the functional currency and the local currency. And if that's the case, you're going to have always on the CPA exam, the reporting currency on the exam is always the US dollar. So you're going to translate the English subs denominated in pounds, which is the local and the functional currency, to the US, the reporting currency. So when the local and the functional currency are the same, and you're going to have to turn that functional currency into the US reporting currency, now you need to know that you would use the translation method. Now that tells you, then I tell you here what balance sheet, what rates to use. You use the year-end rate for everything on the balance sheet except common stock and APIC, which you will use the historical rate. And we're going to see that retained earnings you'll roll forward. Beginning balance of retained earnings plus net income minus dividends gives you ending balance. For your income statement items, you use the weighted average. The process is you start with the income statement, close net income to retain earnings, plug to make the balance sheet balance, and that plug is going to be the translation gain or loss, and it's going to be part of other comprehensive income. And again, guys, just know that it's part of comprehensive income. You don't need to worry about that bottom part. It's what it is in a mnemonic that helps us remember comprehensive income. That's not important for us at this point. Okay. Now you come over and we can go back now to the text. Okay. Because I just wanted you to get an idea in your head that uses example of countries and stuff. When you look at the text, okay, and you start to look at this example here, okay, and notice now we're putting it in language of maybe how the exam would ask you, which is what? Reporting currency equals the functional currency, okay? That means that what? That means that the US is probably going to be their primary economic activity. And when you're going from the reporting currency, the functional currency to the reporting currency, you know, then you're in a situation where you're going to go ahead and you're going to use the remeasurement method. And that's going to tell you what steps you have to do to turn the local currency into the reporting currency. Okay, so you come over and when should we use the remeasurement method? And they tell us the reporting currency is the functional currency and the remeasurement method must be used. Okay, when the foreign subsidiary is highly integrated with the parent and day-to-day operations of the subsidiary depend on the reporting currency. So you can tie that back to what our situation number one with the what English sub doing most of its business in the United States. Okay. Now, when you use the translation method, as we saw, now what? Now the foreign subsidiaries, foreign currency, which is also the local currency. Okay, let's put that word local on there in case they call it local on the exam. Okay, when the local currency is also local/foreign currency is also the functional currency, then you use the translation method to get to the reporting currency, which again is what always US dollar on the exam. Okay, but let's see what they say sort of in exam language here. Now the foreign subsidiary is relatively self-contained and operates independently, primarily in local markets. Day-to-day operations do not depend on the reporting currency. Now, if you think about our little example, that was what? That was a situation where we had the English company doing most of its business in England, and the US is the parent, right? Okay. All right. So that gives us a sense of the examples here. I'm going to come back to scenario 3 here in a couple of seconds, but notice here they're telling you that if you're doing what? If you're doing remeasurement, they tell us what rates to use, which I already gave you on that flashcard. So right now, that flashcard is pretty much containing everything we need to know. I mean, what we mean by current rate versus historical rate and stuff. I had your flashcard on another page. But in terms of what rates to use on whether it's monetary or non-monetary item was on that flashcard for the balance sheet, for the income statement. When you have a remeasurement gain or loss, that's reported on the income statement as part of income from continuing operations. If it's the translation method, okay, translation method, by the way, they could also call these the temporal or the current method. But if it's the translation method, okay, foreign currency equals the functional currency, foreign / local. Okay, let's fix that up too over here. Here, functional equals reporting. I don't know why they didn't say that. Maybe they did, but anyway, functional equals reporting, right? US is the functional currency, and of course the reporting currency always on the exam. They tell you what rates to use. Same thing here. They tell you what rates to use. I already gave you that on the flashcard. And now the translation gain or loss is part of other comprehensive income. And I gave you that on that flashcard that I just had up on the screen. Okay. Okay. Now let's come over and let's look at this example, guys. And you'll see that if you were to get something like this on the exam, you might be kind of, nervous at first, but it might actually be kind of fun as you go through. And depending on the fact of the problem, remeasure or translate, and they're going to show you both here, okay? But let's just go ahead, and they give us the information about the financial statements, okay? And they give us the exchange rates, okay? What is it at December 31st, year 2, when the company was formed? That's going to be the historical rate. They give us the rate for some various times during year 2. Okay, now in this problem, they gave me the weighted average rate. Okay, now you could probably do this on your own, not have me show it to you, but I'm going to go ahead and I'm going to show you how they came up with that 0.18. Okay, so they had what? They had the historical rate, and it was in place from what? January 1st of year 2 to June 30th. Of year 2. So that historical rate, not June 30th, but excuse me, April 1st. Okay, because at April 1st it changed, but the 0.18 was in place for what? For 3/12 of the year. So you'd multiply that times 3/12, that gives you 0.045. And then you've got what? You've got this April 1st, year 2 to June 30th is 0.13. So that's also 3 months. And so that's going to give you 0.0325. And then you had this 0.1, which essentially they tell us was in place for 6 months, right? So that's going to be 6/12 to make up the back end of the year. That gives you this 0.05, and you do the math on that, guys. You add those all together, that's where they came up with this 0.1275. Okay, so if they make you calculate the weighted average, that's how you would do it. Okay, now this 0.10, by the way, which is in place at the end of the year, could also, let's just put AKA spot rate. So if they call it the spot rate, just know that that's the rate that was in effect at the year end, okay? Inventory was acquired evenly throughout the year, so that means what? Okay, we're gonna have to use the weighted average for that. And fixed assets were acquired at December 31st, year 1. That's pointing me to what? The historical rate for my fixed assets, okay? Now you come over and they start to show you how to do either the remeasurement or the translation. I'm going to start with remeasurement. Okay, it would depend on the fact pattern Are we dealing with, the US dollar being the, functional currency? If the US dollar is the functional currency, then we're going to go ahead and use the remeasurement. If the local currency is the functional currency, we'll use the translation, right? Okay, so, these would be mutually exclusive examples. Now, if you look, you can see these little watermarks, okay? See the 1 and the 2? That's that process where I was telling you, hey, start with the balance sheet, start with the income statement. That's at the bottom of your flashcard. So if we're using remeasurement, what I said at the bottom of the flashcard is, okay, start with the remeasurement of the balance sheet, okay? So that's what we do here. And for our monetary assets, we use the spot rate. So you take that 10,000 times the 0.1, remeasure whatever this local current, whatever this foreign currency is to the functional / reporting currency, the US dollar on the exam, okay? We go ahead, we make all those calculations, okay? For inventory, we have to use the weighted average because the problem told us that inventory was acquired evenly throughout the year. And then for our fixed assets and the related accumulated depreciation, per our flashcard, we are to use what? We are to use the historical rate, right? So we go ahead and we do all that, and we come up with our total assets of 63,653. We do the same thing for the liabilities. Okay, pointing to the wrong thing there. It's that 34,000 times the 0.1, right? It gives me this 3,400 and so on, okay? And I go ahead and I do all that work using the proper rates, okay? For common stock, I'm going to use the historical rate, okay? Now, what happens? When I add the 3,400, the 13,200, and the 36,000 together, when I add those numbers together, okay, I get a total of 52,600. 52,600, okay? So I'm asking you now, does this 52, I don't know why I wrote 56, 52,600. So I'm asking you, does this balance sheet balance right now? And the answer is what? No, it does not balance, okay? It is off by what? By 11,053. So I plug that into my retained earnings to make the balance sheet balance. Now, since this company just started operations, okay, that means that the beginning balance in the retained earnings was what? 0. I have to add my net income. I subtract dividend, okay, and that gives me the ending balance, which I just plugged the ending balance in there to say that it has to be 11,053. And since they didn't tell me that there were any dividends in this question, then I'm saying the net income must be 11,053. So I take that number, which I have kind of plugged in as the net income, and I put it on my income statement and say, okay, my net income is 11,053. Okay, then I go through the process and I remeasure the income statement items pretty much using what? Using the weighted average rate that I showed you how to calculate. Okay, except for the depreciation, because they told me that that was related to assets that were required when the rate was 0.18, that historical rate. Everything else, I use the weighted average, okay? And when I do, if you take 66,938 minus the expenses of 62,739, that difference right there is 4,199. But I already said that my net income is what? 11,053. So to make the income statement work correctly, so that revenues minus expenses give me a certain net income, I have to do what? Report a foreign currency. In this case, it's a gain because I'm trying to get up to a higher net income that I plugged in there. That's a gain. That's reported on the income statement. That is part of my operating income. Now, the thing that I don't like about this problem, and I think they were trying to keep it as simple as possible, is they assume that the retained earnings had no beginning balance. It was the beginning, their first year of operation. What if the beginning balance was, say, 56? And they told you that there were dividends of $3. Well, that would mean now that the ending balance before the plug, okay, and I'm going to have to add my net income. I subtract dividend, add net income, which is what I'm trying to figure out here, what that number needs to be to make the balance sheet balance. That means that the ending balance in retained earnings would have been what? Would have been 53. And since I needed 11,053 to make the balance sheet balance, then what would be the plug to my net income? That's a question.
41,947.
On what planet? If I need a plug of 11,053 when the retained earnings had a balance of 0 to get it to an ending balance of 11,053, what do I need to do to make this be 11,053, which is what I need the ending balance in the retained earnings to be?
Oh, it should be a loss, right?
Okay, obviously this example isn't working for you. Okay, if the ending balance has to be in retained earnings has to be 11,053. I'm telling you it had a beginning balance of 56. The dividends were 3. That means before any plug, it has 53,000. What does the plug into the retained earnings have to be to bring it up to 11,053?
11,000.
Has to be 11,000. And so in that situation, this 11,000 would what? I'd put 11,000 here, not 11,053. That would make the balance sheet balance. And then I would have what? I'd have income of 11,000, and then I would go through that process, etc. Roy, are we good on that now?
Yeah, I got it. Got it.
Okay.
Thank you.
Yeah. Okay. So that's how we would have to do that, because I don't think on the exam you're going to run into a problem where they just tell you there was no. If they were, you do it exactly the way the book contemplated. I have a feeling the exam, would say, okay, the beginning balance retained earnings was this amount. They paid dividends of that. You'd have to say, okay, that means that the ending balance without the plug in the retained earnings would be this. I need the ending balance in the retained earnings to be a different amount in order for the balance sheet to balance. That's what you put in as net income. Whatever it is that you need to put in the retained earnings to make the balance sheet balance, that's the net income. And then that's the number that goes up as you then remeasure the income statement and figure out that remeasurement gain or loss. And it could be a gain, could be a loss. Okay. Okay, good. Now we're going to show you the translation method. Okay. And with the translation method, again, on that one-stop flashcard, it told you the exchange rates to use. It told you the situation that would lead you to using the translation method, in which the functional currency and the reporting currency are the same. So we're going to have to go from the local currency to the functional / reporting currency. And so we would use the weighted average rate for everything on the income statement. We go through, we figure out what our net income is. Okay. By using that amount, okay, we use the current rate for everything on the income statement. The weighted average rate for everything on the income statement. That tells me what my net income is. In this example, since the beginning balance of retained earnings was 0, okay, going back here now, that means that the ending balance retained earnings is 53.54 because there was no dividends that were paid out. So I just stick that into my retained earnings to bring the retained earnings balance up to whatever it's supposed to be at that point in time. Just calculate your net income, add it to retained earnings. That's all you have to do there. Okay. Then what? If the retained earnings had a beginning balance, then you'd add the net income to the beginning balance. And if there were dividends during the period, you subtract the dividends to come up with the ending balance. So you would do all that work, I guess, on the statement of retained earnings. But in this case, they just had net income. They didn't have dividends or anything. Okay. All right. So that number comes down to the retained earnings. And now I proceed to translate the balance sheet. And I use what? I pretty much use the spot rate. Okay. Pretty much using that spot rate for all of those. And I use the spot rate for the liabilities. And then I use the historical rate for the common stock. Okay. Now you see the total assets. If I add 34 plus 13.2 plus 36 plus 534, if I add these numbers up right here, okay, if you add all those numbers up, you get 57,954. Does the balance sheet balance? No, because total assets are showing 40,800 and the liabilities plus my stockholders' equity is showing 57,954. We've been around this stuff long enough to know that the balance sheet must balance. So what do? We report a subtract from my liabilities plus stockholders' equity to make the balance sheet balance. That subtract is 17,154. That is going to be shown what? As a subtract in my accumulated other comprehensive income. I don't know why I had an upward inflection in my voice there, period. Okay, that is the amount that we show as for foreign currency anyway in my accumulated balance of my other comprehensive income. Of course, this is assuming there were no other comprehensive income, accumulated other comprehensive income items. If they were, then that would change what the plug needs to be to make the balance sheet balance, right? Okay. Okay, now quickly, because I think we're spending more time than I had anticipated on this, but anyway, quickly, I want to show you one more thing here before we take a break. Well, two more things. In the example, we just had two countries, okay? You could run into a situation on the exam where maybe they'll ask you about a third country involved in something like this, okay? And if that's the case, and that was that other scenario that we saw in the book, you're going to have to do both things. When I say we saw it in the book, that was that third column. There, should I show you an example of that? Okay. So now when you look at this one, this is another flashcard. Okay. Now we got a three-country example. Okay, so the facts here now, just looking at this panel over here, okay. English company is a subsidiary of a U.S. company, and its primary market is Europe. In this case, the euro is the functional, the pound is local, and the U.S. dollar is always the reporting currency on the CPA exam. So first, you have to do what you're supposed to do, which is remeasure the financial statements from the local, the pound, to the functional. Okay. Now, if we were talking about the U.S. being the primary activity, you'd stop there because the dollar already is the functional currency and it's the reporting currency, so you don't have to go any further, right? Here now, and again, it's the same rules when you remeasure as to where you report the remeasurement, gain or loss, what exchange rate to use. But now we went ahead and remeasured, but we're not done. Now we have to translate the what? Now we have to translate the functional currency, which is the euro, into the reporting currency, which is the US dollar. Okay, so when you end up with the US dollar, from that different functional currency, then you have to translate. So we go through, and I don't know about class question 16, guys, you can get rid of that, okay? But we go ahead and we're going to do that, and we tell you what rates you have to use, and so that we ultimately end up in the US dollar, okay? You're always gonna end up in the US dollar as a reporting currency, but we had to do both things. First, we had to remeasure from the local to the functional, and then then we had to go from the functional, which was the euro, to the reporting, which is always the US dollar, and we use the translation method for that. I'm thinking you probably won't get a 3-country example, but okay, if you did, that's how you would do it. Okay, and remember, translation gain or loss is part of my comprehensive income. I don't know that we knew those mnemonics are old. Okay, now come over and let's look at, go back to the book. And I'm going to come back to the individual transactions. I just want to look at this question here while this is sort of, fresh in our mind, this first question. Then we'll come back and we'll work this question too. When I say come back, after we work question 1 and I show you transactions. But let's just work this question 1 right now. Okay, guys, for the sake of time, I'm going to go ahead and end the poll. And it looks like most of us got this right. Okay. Now, remember, guys, when you're doing something like this, the choice is B. This question really is asking you, well, do you know where remeasurement should be reported? Remeasurement gain or loss should be reported versus translation gain or loss. And the answer here is what? Remeasurement gain or loss is reported what? On the income statement. And that's what they asked me. Which of these would hit the income statement? And the answer is just the 7,600. Now, it's kind of interesting because that remeasurement would first be what? Would first be reported as a difference between, I guess, the German and the Swiss franc. But then whatever that remeasurement amount is, will stay on the income statement, and then it'll go ahead and what? Be translated over, and then we'll go ahead and go through that process of what? Of changing over the balance sheet in the translation, having that plug and retain earnings, pulling that up as my income, and as part of that income number, that's going to be reported there as the amount that gets plugged on the income statement, and resulting in the $7,600 gain that's reported on the income statement. Then I would have to do what? Translate now the Swiss franc into the reporting currency, the US dollar. And now that what? That translation, okay, and again, the key word is the translation, where they tell me what amount of imported foreign currency gain in the income statement. That translation amount is what? That's other comprehensive income, right? It's not on the income statement. Okay, so I think a couple folks picked D, which combined the two. No, and I think someone picked C. C, if we didn't have this other country involved, C would be the answer for the amount that's gonna, or whether we had it or not, C would be the amount that would be reporting as other comprehensive income. Okay. Question? Okay, good. Now you come over and let's deal with individual foreign currency transactions, and you might see a couple questions like that, and it's just a current transaction. I think in this example, you have a U.S. company dealing with a Mexican company. They buy some product, and they're going to have to deal with the transaction from pesos to turn it into dollars so they can report in their financial statements. Okay. Now, there will be a gain or loss in the exchange rate between the time of purchase or sale and the time that the payment is actually made, or at year end. If we need to do this, even if we haven't settled the transaction yet, at year end, we may have to make an adjustment so we can report our year end statement. Okay. Okay, good. So with that, let's just go ahead and let's look at this example. Okay, we've got this company that purchases goods for 100,000 pesos, and they tell us the exchange rate at the time of the transaction, what it is at the end of year one, what it is at the end of year two. Okay, and they give us these, not the end of year two, but in February year two when the payment is made. Okay, so we go ahead and at the time that we make the purchase, we debit our purchases, maybe our inventory, depending on what method we're using here for our inventory. And then we go ahead and we turn the pesos into dollars using the exchange rate at the time, set up the account payable. Okay. Now, when we reach the year end, they tell us that the exchange rate has moved what? Has moved in our favor. Now it's going to only cost us 8 cents per peso to pay that thing off. So we have a gain. So we'll reduce our accounts payable because now we're going to have to pay a total of 8,000 to settle this thing. And we're going to credit foreign exchange transaction gain. That's reported on the income statement. Okay. And then when we finally settle, now if you look, well, the exchange rates moved back a little against us here. Now we've got to pay 9 cents to the peso. So we obviously are going to have to pay what? $9,000 to settle this. We liquidate that receivable. The receivable went from, originally not receivable, but payable. We had originally set it up at 10, then we debited it right there for 2. So to close it out, we're going to have to go ahead and debit it for what? 8, because we're paying that off. And now we have a loss because between the end of year one and by the time we paid that in year two, the exchange rates had moved, the other way against us. Okay. All right. So that's pretty easy, but let's just go ahead and practice with this last question. Then we'll take the break. Oh, put the poll up. Okay, guys, let's go ahead and end the poll and take a look at this one so we can go to the break. And yeah, most of us got this right. Okay, now to me, the problem with the question like this, or the danger, I guess, of a question like this, is that you would forget what date the question was asking you. You wouldn't realize that they're asking me what the year ended December 31st, year 4. So they're not asking me when it is when I settled it. They're asking me at December 31st, year 4. So even though they give me the settlement amount at the end of when we settled it in year 5, in March of year 5, that's irrelevant. Okay, I just need to understand that what at the time it was 55. Okay, and by the end of the year, it had gone to what? 0.7. So, and I haven't settled it yet. So I really don't know what the ultimate settle price is going to be. So rule of conservatism say, well, you got to take the loss on that right now. So I say, okay, 0.15 times the what? It's 10,000 foreign units. And that's where we got the 1,500 from. Okay, and then later on, when it would move back, and I would liquidate this thing, I guess I'd have what? I'd have a amount that I would take as a gain, because it would have gone from 0.55, 0.7. No, it's moved against me. Yeah, it's come back to 0.65. So I put a gain in year 5 in this example. Okay, but they weren't asking year 5. Okay. Okay, good. Guys, make sure you look at the module on income tax. That is heavy on the exam. We're not going to get into that here together. We had decided last time to keep things moving along, that we would go ahead and look at the pre-recorded information from Becker on that. And we are going to jump ourselves into, and I'll put it up here in a second. I had it open, but now it's gone. We will go ahead and take a look at that, start looking at chapter 7 when we come back from the break. Okay, so I'm showing 7 o'clock. Let's shoot for 7:10, and we'll come back and pick up with the beginning of chapter 7. Okay, guys, I want to go ahead and get us started back. I'm hoping to get us through a couple modules here in chapter 7. Just to look at some of the potential point value for these areas. Stockholders' equity, they're going to be asking you some things about how to account for different shares. For example, if we have cumulative preferred stock, if we have fully participating preferred stock, how do you account for that? That comes out to about 5 points on the exam. Pretty straightforward stuff. I'm not going to cover that with us together in class with the time that we're running out of here. And so I'm going to ask you to take a look at those pages on your own, okay? I'm going to talk about stock compensation here at the beginning of when we start talking about chapter 7 here in a couple of minutes. That's about a 5-point area on the exam. And because stock compensation is a fairly popular subject these days, I could expect that you might see a couple of multiple choice questions on that. So I want to spend some time with that. When we get into earnings per share, okay, and I'm going to draw the point numbers over here. This can easily be a 10-point area, has long been a heavier area on the exam. And we're going to start talking about primary versus diluted earnings per share, okay? And I think you'll see that this stuff takes a little bit of practice to get used to it. It's not terribly difficult, but I do think you're going to have to spend some time with this. So I'm going to go ahead and cover that with you because both the point value and the potential, maybe a little struggling you might have with that. Statement of cash flows, okay? Statement of cash flows is easily a 10-point area on the exam. I'm going to ask you to look at that on your own because I think you've had exposure to statement of cash flows. Unless there's a strong sentiment now that I will go through that next time with you. I can go through it next time. I'm thinking we might be more economic here with our time if I have you look at that on your own. And then we'll turn our attention to chapter 8 next time. What do you think? Do you want me to do that next time so I know to prep for it or not? Or you want to go ahead and jump into chapter 8 next time and we'll start talking about governmental next time, which is a heavy area on the exam that most of us have not had exposure to. So I absolutely want to spend some time with governmental. What do you think about statement of cash flows for next time?
It's governmental, has a lot of points and
governmental is 20 to 30 points. Between governmental and not-for-profit, we're talking about 30 points on the exam. Many students get blindsided by that one. So I'm definitely going to spend time, some good time with that. But what do you think about statement of cash flows?
Let's focus on governmental and nonprofit.
Okay, so we'll get to that starting next time. So please look at the recordings, okay, from Becker for stockholders' equity, statement of cash flows, and then this very light area, 2 points. I don't know, guys, quickly look at that video. Not much that they're going to be asking there, but don't ignore it. But I don't think you have to worry much about that. Okay, question? Okay, good. Thanks, guys. So let's go ahead then with all that. And let me jump down to stock compensation. Okay. And the reason this is a fairly popular area on the exam is that there's a fair amount of controversy around how do you account for stock options. There was a time where as long as an entity set the option price above whatever the stock was trading at the time they granted the option, they didn't have to take any compensation expense. Then some controversies came up and whatnot, and FASB said, okay, in response to all of these shenanigans that have been happening, we're going to make you take compensation expense based on the value of the option. And so that's what we're going to be looking at here. And the accounting is not really that difficult, but I think it's worth spending some time with to make sure that we are comfortable with that. Okay. So when a stock option plan meets the requirements of a non-compensatory plan, it does not require recognition of compensation expense. Plans that do will have the compensation expense. Okay. So that's what we're looking at here. And they're going to give us some definitions, okay? And let's just take a look at a couple of these definitions. Option price is the price at which the employee essentially, or whoever is getting that option, will be able to buy that stock for at a certain point in time. The exercise date is the date in which they can actually exercise the option. The fair value of the option, that's the number that we're going to be leveraging off of to figure out whatever the compensation expense is, determined using a model. Often the Black-Scholes model is one that is commonly accepted. The CPA exam will not make you calculate the value of the option. They will give you that value, but you're going to use that fair value to do most of the calculations in the problem. The grant date is the date that they grant the option. The vesting period is how long it takes until the employee can actually exercise the option. Often they'll give you the option today, but they won't let you exercise it for a couple, 3 years because they want to see you work hard over that time, right? And so that would be the vesting period. And then the service period is the period from the date that they grant the option, I should say, until the date that you were able to actually exercise the option. The vesting period, they might say you have to work for a year before you vest, but the service period is over 3 years. We're granting you the option today, but you're going to be working hard over the next 3 years, but the option may vest at the end of 1 year. Okay. All right. So when we go ahead and we calculate the compensation expense, we're going to use the fair value method, which means that the CPA exam will supply us the fair value number. Okay, so let's just look at this, guys, and I think you'll see it's fairly straightforward. I find it a little bit interesting to see, hey, I'm going to be working for a startup company in Silicon Valley, whatever. Oh, I don't know, maybe they're going to be firing people soon, but whatever. I'm going to be working for one of these companies, and they're going to offer me as part of my stock, as part of my compensation package, stock options. Okay, and that commonly happens here in the Bay Area. So what happens? January 1st, we're granted options, exercisable after December 31st, year 2, to purchase $10,000 of $5 par value stock at $25 per share. On the grant date, the market price of the stock was $20 per share. And they're telling you that the value of the options, the total value is $50,000. That's the number that we're going to leverage off of to calculate what is the compensation expense. And they want us to go ahead and prepare the journal entries to account for this whole thing. Now, what happens? You come over and there's nothing that happens at the grant date. It's as you provide the service, you're going to take that $50,000. And since they told us that it's going to be granted on January 1st, year 1, and it's exercisable after December 31st, year 2, that means we have a 2-year service period. Okay. And that's what we're going to have to allocate that $50,000 over the 2 years. In other words, that's $25,000 a year that we take as compensation expense as we provide the service. $25,000 year 1, $25,000 year 2. The credit goes to a stockholders' equity account called additional paid-in capital stock options. Okay, so you go ahead and this is a stockholders' equity account. Now, at the time that FASB came out with this whole little requirement, a lot of the Silicon Valley companies at Business Roundtable stood up and said, oh, you're hurting technology companies because they won't be able to attract any talent. And I'm like, well, why would that be? You're simply taking an expense as they provide a service for you, and that expense is having actually zero effect on the net value of the company because you're crediting additional paid-in capital at the same time. In fact, what's coming is what? More cash. More cash is going to come into the company at some point in time. So why they were saying that was such a bad thing, I don't know. It affect your net income, but your net worth of the company would stay the same. It'd be a wash, right? So what happens? Now we go ahead and we debit the cash when the option is exercised, $10,000 at $25 per share. Is that more cash? We do what? We issue the common stock at par. It was 10,000 shares that got issued at par. That's easy, okay? The additional paid in capital, how do we come up with that number? Well, if the par value of the stock, we're issuing it for 25 under the stock, under the option price, the par value of the stock is $5. That gives me what? That gives me $20 per share times the 10,000 shares. That's what? That's 200,000. And then what? And then you look and you say, well, they're reclassing what? This APIC stock options, and they're reclassing it out of APIC stock options into what? Into regular APIC. That's how we get the 250,000. Okay. Now let me ask you a question. By how much from this whole transaction, by how much did my stockholders' equity go up from this whole transaction?
$50,000.
300,000?
Close, because you're looking at this, right, Eric? But,
50.
huh? My stockholders' equity, okay, let's remember what stockholders' equity is. It's common stock, it's additional paid in capital, it's other accumulated other comprehensive income, but that's not relevant here. And it's also what? Retained earnings, isn't it? So what happened to my retained earnings as a result of this whole transaction? What happened to my retained earnings as a result of this whole thing?
Reduced by 50.
Well, it got good. Thank you. The retained earnings came down 50. The stockholders' equity came up what? 300,000, didn't it? Guys?
Yes.
Eric had said. So what happens? My stockholders' equity came up by what? By 250? How much cash should I get? 250? Okay.
Mhm.
So ultimately what happens is your stockholders' equity comes up by the amount of cash that you got. So I found it a little annoying when the GAO, when I was a member of the GAO, and we met with, you know, people like the Business Roundtable, sat there and said, well, look what you're doing to us. They're going to make us recognize this compensation. But at the end of the day, your stockholder equity going to go up if you account for it like this by the amount of cash that came in. So what's the problem? Okay, but they didn't like me asking that question. But anyway, that's probably why I didn't get put on any more assignments, meeting with high-level people. Okay, now what happens when the options, if the options expire? Okay, then all you would do is simply reclass the additional paid in capital that was in the stock options. By then it would have been up to that, you know, full 50,000, and credit the additional paid in capital. So that case, since no options came in, no cash came in on the options, it would be a wash on your stockholders' equity, and that you would have had a reduction in retained earnings, but your additional paid in capital stock options would have gone up. So, you know, the other thing, if you're thinking about the entity statement of cash flows, it's a good thing for the statement of cash flows. If you were using the indirect method on the statement of cash flows, you'd have net income, and then you would add back any compensation expense here because there's no cash associated with this 50,000 that's going out. All right. Okay. Okay, good. Now, if some of the options expire and some are exercised, then you simply do what? Then you simply bring in the transaction based on the amount that had been exercised, and the amount that expires is handled by as the amount that expires. I don't know that that's that important to spend much time talking about. Okay. Okay, good. Stock appreciation rights, very quickly. Okay. And with the stock appreciation right, okay, compensation expense for stock appreciation rights must be adjusted annually to account for changes in the market price, okay? And they do not require employees to make a cash payment, okay? So just flashcard that, but I think you'll see this is pretty straightforward. We have these options, stock appreciation rights, I should say. They come in and it's $30 is the market price at the end of year, at the beginning of year one. End of year one is 45, and end of year two, the market price has come down to 40. Okay. And then this more exercised all the options, at the beginning of year three. And we're going to look at the journal entries associated with this. So market price at the end of year one was 45. Okay. Market price at the beginning of year one was 30. So there was a $15 appreciation in the market. The number of shares that would have, potentially involved in this was the 10,000 shares. Okay. So we go ahead, and for that difference of 15, we say, well, the total compensation is 150. But because the service period is for 2 years, okay, then we would take that 150, divide it by 2, and we would take 75,000 that first year. Okay, now what happens? By the end of the second year, now the prices come down a little bit. The market price come down to 40 versus what it was at the beginning of year one. So the appreciation in value has only been 10,000. The number of rights outstanding is 10,000. So we need 100,000 now in that account. And we're looking and we're saying, well, look, we already have 75 in there. So we're only going to take an additional 25 to bring it up to what we've estimated we need in there, the 100,000. Okay, so that's what we mean by adjusting it. And then when he finally goes ahead and exercises, we would go ahead and debit the liability and credit the cash at that point in time. Okay. Okay, good. Now we go ahead and let's look at this question. There's my poll. There it is. Okay, guys, we're coming up on 2 minutes, so I want to go ahead and end the poll here. So make your best choice, please. Okay, and okay, we got 75 on this. Let's just take a look at this question. And we have this compensatory plan, and it entitles this person to get 1,000 shares at $10 par common stock. The options call for a price of $20 per share that are exercisable for 3 years following the grant date. Morgan exercised the options on December 31st of the current year. Okay, so it didn't say they had to wait 3 years. They said they were exercisable for 3 years, but he was able to exercise them all December 31st, the same year it was granted. The market price of the stock was $45 on January 2nd and $70 on December 31st. I don't care. Using the acceptable option pricing model, Morgan determined that the fair value of the option granted was, thank you, 30,000. Okay, and then they say by what net amount should stockholders' equity increase as a result of the grant and the exercise of the options. Okay, now what happens? Well, they don't tell us that, there's any, service period that's attributable to this. So, it's exercisable for 3 years, but they essentially earn it either immediately or at the end of the first year, because the guy went ahead and exercised the options at the end of the year. So he was able to do that. So the assumption here is he worked hard for this 1 year. So what happens? You would go ahead and you would take the 30,000 divided by what? 1 year. That's the period. I'm assuming he has to at least work a year to get this, but all I can tell from this problem is he exercised the options by the end of December 31st. So for that year, he worked hard, right? From the date they gave him the grant to the date that he finally exercised it. So I would have what? I'd have compensation expense of 30,000, and I'd have APIC stock options, STOCK, of 30,000. And then when the dude exercises the options, what's going to happen? Well, if it's $20 per share and he's doing 1,000 shares, the company's going to get cash of 20,000. They're going to debit APIC options, stock options, what, 30,000. Take that all out of there. They're going to go ahead and credit the what? Common stock at par. The common stock at par is 10,000. And then they're paying what? They're paying $10 per share for stock that has a $20 per share, right? So the APIC is going to be what? Is going to be 40,000. The regular APIC is 40,000 here, right? Which is the 10,000 that came out of the, the 30,000 that came out of the, the reclass out of stock APIC options into, and then the additional 10,000, which is the difference between the option price and the par value of the stock. So that's where we get that 40,000. But the question asks you, well, by how much did the stockholders' equity go up? Well, my stockholders' equity did what? You look here and you say, well, it came up 50,000, John, but at the same time it came down what? Came down 30,000 by the compensation expense I took. So the answer is what? 20,000, which is the amount of cash that came in. So it always goes up by the amount of cash that comes in, right?
So I got a quick question. So this is kind of saying that when employee stock option compensation is exercised, it's kind of like little miniature secondary offerings each time. So the shares outstanding grow and the capital grows. Is that accurate?
The shares outstanding grows and the capital grows unless they give them the stock options for free.
Yeah.
Yeah.
Okay. So
Yeah,
if they
that's why
exercise, like if they exercise at some price, then they're actually, it's like a secondary offering.
I don't know about what you mean by secondary.
I mean, they're issuing more more financing.
They're issuing more shares. Yeah.
Okay.
In fact, we're not gonna have time for it. I'm realizing I don't want to get into it, so we're gonna wait till next time to do earnings per share. But we're gonna see, Eric, that you literally have to pretend like the options got exercised to calculate a potentially dilutive earnings per share. So they actually make me report lower earnings per share for stock options. Because that's what they're telling me. We're diversifying the ownership. Now, we're not diversifying, but we're spreading out the ownership. However, often stocks that are issued in this kind of deal don't have voting rights. So they're often, I forget what they call those, non-voting right shares that end up getting issued in a situation like this. So I don't know that you're turning over control of the company, but certainly you're diluting the earnings of the company as you issue these more shares.
So technically it is a form of financing for the company.
I don't know that that's why the companies do it. It's a good way to attract talent with no cash consequence. In fact, more cash is coming in. So it's a nice little tool for a startup, right? For smaller companies are the ones that like to do this. You know,
That's kind of exactly what I meant, like small companies, because they can't really issue stock easily, you know, but a small company, maybe they could issue stock compensation easily.
I don't know about how hard or how easy it is. I mean, you got Series A, which is basically, you got angel financing, you got Series A. As you move further up the chain of financing, it gets a little more of equity-based financing, it gets a little more difficult because you got to do additional registrations and whatnot. But it is a way of, if I had to, sort of put a label on this, it is a way of attracting talent without using any cash. And the only, downside that I see to the company is your income will be lower. But so what? Most of these companies in these early phases of startups show losses anyway. So, you got more cash coming. It won't affect your cash provided by operations. In fact, it's going to increase. It won't increase your cash provided by operations because this would be cash from financing activities when it comes in. But there's no impact on cash provided by operations on this. So anyway, interesting stuff, I guess. What sometimes happens, rather than get additional cash in, sometimes what they'll do is they'll take some of the shares from the employees. So in other words, they'll look at, say, well, look, we're giving you an option price of $20 per share. The stock is trading at $40 per share. You were going to have to come up with $20,000. So give up 40 times, whatever that is. Now I lost track of the numbers, but they'll take some of the shares away from you to pay for the shares that, that you're going to be being issued. So that, because a lot of times employees themselves, well, I ain't got 20,000. So they'll take some of the shares away from you to make up for the cash that you're not going to pay them. And then they'll do this transaction just by debiting the APIC, creating common stock, and crediting APIC for the number of shares that you were left. And you don't get any cash out of that. So the number of shares would come down. Okay, I'm gonna stop there because I can't do, I thought I could, but I don't want to get into this halfway through a module thing. So next time, we will finish the next module here on earnings per share. And then we will turn our attention to chapter 8, starting with governmental. We'll finish governmental through to chapter 10, and then we'll come back as we complete the course to the beginning of chapter 8 for not-for-profit. Governmental is the heavier area. Governmental constitutes about 20 points on the exam, not-for-profit about 10. Okay, so I want to make sure that we do a good job to get this governmental under our belt, and then we'll turn our attention to not-for-profit. But I do want to go through this earnings per share step with you next time. So finish chapter 6, modules 1, 2, 3 in chapter 7. We'll do module 4 together, and then you got that statement of cash flows module that you need to do for chapter 7, and then we'll hit the ground running. Well, we'll eventually hit the ground running for chapter 8, the governmental, next time. Okay, guys? Question? Okay, I'll see you next time.
Thank you. Have a good
Thank
night.
you. Bye.
Thank you.
Good night.